Hello, I'm Dean Jenkins, founder of FollowMeTrades.com. I've been consistently beating the major indexes by several multiples for several years with minimized risk. People ask me all the time, Dean, how do you find great stock picks? What's your criteria? Well, I'll show you. I'll walk you through how I pick great stock trades. So come on, follow me.
Before I get into a discussion about how I pick stocks, I wanted to clarify a couple things here. First, I look for stocks and ETFs to trade, and that's different than a long-term buy and hold investment strategy. I do it in an investment account to grow my investment account, but trading is different than an investing strategy. The typical time that I hold each stock or ETF is 1 month to a few months. And second, I'm a technical trader versus a fundamental trader. I analyze the price patterns on the charts. I don't study earnings reports, company forecasts, products management. I don't get into that. I strongly believe that those fundamentals do matter a lot. But I also believe, and I've learned, the price of a stock is really a reflection of what the market thinks of the company's fundamentals, so that everything that is known about a particular company and a stock and what the market thinks about that, it's reflected in price patterns on the chart. The stock's price movement is based on what the market believes about the company. And these price movements sometimes have a very clearly discernible pattern, can help us predict what the stock's going to do next. And there's really only two realities in the market, in the stock market. That's price and volume. Those are indisputable. A certain number of shares were bought, certain number of shares were sold at a specific price. And that's a reality. And everything else is really subject to interpretation, manipulation, speculation, emotion. And I base my analysis on the realities on the stock chart that present themselves in front of me. So here's my trading criteria. First is that I want to trade in the direction of the major trend of the overall market or the market sector. I do occasionally take a counter trend trade, but only when the probability of winning is really, really high. For the most part, I trade with the major trend, and that can be up or down. Secondly, I look for trades that have a high probability of winning based on my analysis. I also look for trades that have a high risk to reward ratio, meaning the trade has the potential to make more money, much more money, than it will lose if the trade fails. And I look for trades that fit within my risk management parameters, that the trade has a clear support or resistance level for my stop loss placement. And lastly, I'm looking for trades that have a high capital efficiency. I don't want to tie up more than, say, 10 or 15% of my trading capital in a given trade. Out of 10 trades that I take, 3 or 4 of those are going to fail. But 6 to 7 of them are going to win. 1 to 2 of them are going to win really big. And my winners are, on average, larger than my losers. And my losers, the amount that I'm going to lose on each trade, is completely controlled. Sometimes, to achieve capital efficiency, I buy put or call options rather than buying the underlying stock itself. And when I publish my picks, I also include specific option contract parameters when appropriate. I don't use diversification in the traditional way, but I do pay attention to sector weighting, and I limit my trade exposure in particular sectors. If I'm trading in energy stocks or biotech stocks, I'm not going to have all of my trades in one sector. So to pick great stock trades, I use 3 key tools in analyzing stock charts. I use what is called Elliott wave theory. I use Fibonacci retracements and extensions, and I use the ART or Applied Reality trading software from TradersCoach.com. So Elliott wave theory was developed by a guy named Elliott, Ralph Nelson Elliott. He developed this theory in the 1930s. And he theorized that that the price of a particular stock and the overall stock market itself moves between optimism and pessimism in natural sequences or waves, and that there's a series of impulsive or corrective waves. And here's the what's called the basic 5-wave idealized pattern, and you'll see this a lot again in the overall stock market and in individual stocks, where there's an initial small wave, a correction, and then there's this big impulsive wave 3. Wave 3 is the biggest wave in a sequence. There's a wave 4 corrective wave, there's a wave 5, and then after the sequence there's this ABC corrective sequence that happens. And this can be mirrored for a stock going down. This is a bullish pattern where the stock's going up. The exact same pattern can happen going down. So I'm looking for trades in wave 3 or wave 5. These are the impulsive waves with big dramatic price movement. And again, these can happen in a bullish or a bearish market. And I trade both bullish and bearish markets. The second theoretical tool I use is what are called Fibonacci numbers and Fibonacci retracements and extension. So Leonardo Fibonacci was an Italian mathematician in the Middle Ages, and his important contribution was the Fibonacci number sequence, and you can see it here. It starts at 0, 1, 1, 2, 3. If you want to find a number in the sequence, you add the previous two numbers. So 0 plus 1 is 1, 1 plus 1 is 2, 1 plus 2 is 3, 3 plus 2 is 5, and so on. That's how the sequence goes on. Fibonacci ratios are the ratio of one number position to another, and there's a sequence here. A number divided by the previous number approximates 1.618. A number divided by the next highest number is 0.618. A number divided by two places higher is 0.320, and so on. This ratio 0.618 is called the golden ratio, and it appears everywhere around us in nature and in systems like the stock market. You can see here's the Fibonacci spiral. You find this shape in snail shells, hurricanes, spiral galaxies. They all follow the same proportionality as they expand. It's really interesting. So how does Fibonacci, a Middle Ages mathematician, relate to the stock market? Well, it turns out, looking at Elliott's theory, that the stock market moves in waves, and we see it all the time. And after a wave happens, like right here we have a stock chart, and we have this initial impulsive wave up, and after a move up like this, quite often there is a retracement down, and quite often they retrace down into Fibonacci retracement levels. So I got these heavy green lines, and you can see this chart is retracing, coming back down exactly into this 38.2 to 61.8 Fibonacci retracement level. And when that happens, that's really interesting, and it tells us that there's a probability that we have an Elliott wave sequence beginning. We've got an impulsive wave up, a corrective wave down, and there's a possibility that we're now going to get another impulsive wave up. So this wave went up, it retraced down into a Fibonacci retracement zone, and now we can use another Fibonacci tool, which is called a Fibonacci extension, and the extension levels are 61.8 up to 100%. There's a high probability, since this sequence has started and it's hit these Fibonacci levels, that it's going to extend up into this target zone. So the third major tool I use in my analysis is what's called the ART, or Applied Reality trading software. This was developed by Bennett McDowell, who was my key mentor to help me become a trader. It's provided by traderscoach.com. So the ART, or Applied Reality software, has several components. First, it has what's called an optimum wave locator, which it's a histogram down here at the bottom, and it helps identify the impulsive wave. It also provides what are called pyramid trading points, these little triangles that you see, and these triangles identify key support levels. ART reversal bars show key pivot points where a trend looks like it's going to be reversing. And then the final tool from ART is this precision trend filter. It's just a trend confirmation. So I bring it all together. I use Elliott Wave, Fibonacci, and sophisticated modern art software to identify high probability, high reward trades. When I look at a chart like this, I see an initial impulsive wave up. The optimum wave locator is showing me that. I've retraced down into a Fibonacci wave 4, right down into this 38.2 to 61.8 level. And now the wave locator is going green again, telling me that we've got a good chance of another positive wave starting, and I'm able to establish a price target at these Fibonacci extension levels of 61.8 to 100%. And I can put a price on that, and I can estimate that this chart has a very high probability of reaching into this zone, about $250 from its current price level of $150 per share. That's a trade that's worth taking. In an example like this, I can see a clear place to put my stop loss, and that's right here at the bottom of wave 4. This is about $114. My current price where I'd be entering is right at about $150, and I've got a price target of $250. You can just see that my reward to risk is bigger. If I'm wrong and this trade fails, and about 3 to 4 out of 10 trades will fail, but 6 to 7, 60-70% will be successful, and they will be bigger winners than they are losers. In this case, if I go in at $150, my stops call it $115, then I'll lose $35 per share, and I use my risk management guidelines, again covered in the overview video, so that I'm only have 2% of my entire trading account at risk if I hit that stop. But the amount that I'll make, so a chance of losing $35 per share, but if I'm right and this plays out, and they do most of the time, then I'm going to make $100 per share. So my risk to reward, $35 potential loss to a $100 potential gain. So that gain is over 2 times the amount of the loss, and that is important. I only take trades that have that kind of reward to risk characteristic. Every week I scan through literally hundreds of stock and ETF charts, and I find the absolute best trades. And I'm finding these trades, I'm buying these stocks in my own account with my own money, and I'm inviting you to subscribe and to follow me to take the same trades. So I publish an average of 1 to 2 trades per week. Each trade that I publish includes the price to buy at, the initial stop loss price, and a target price. And then I send at least weekly updates on the trades that are open. I give a brief commentary. I update the stop loss price level if appropriate, and then price levels where we would scale out and begin to take some profit out of the stock to lock that in and to reduce risk. So I'm doing this work already from my own trading account. Again, I'm trading my own money on these trades, and I invite you to follow me and to share in my success. These are time-tested and proven methodologies for consistent profitability, and I've achieved consistent and really good profitability in my own trading account. I've done this by following strict risk management rules at all times, by maintaining a high win ratio. So my 3-year average is 67% of my trades win, and a high payout ratio. So the amount that I win on trades is 2.7 times more than I lose on trades. Having some trades lose is inevitable, and just don't let anybody tell you differently. That's a reality. We just can't be right all the time. But by controlling risk, and by having a high win ratio, and by having the winners consistently bigger than the losers, I'm able to consistently be profitable and minimize my risk. So I invite you to follow me, to share my success, to get great returns, to do it with limited risk, and I've tried to provide a simple method that's really easy to follow. So the only question is, are you in? Thank you for watching, and if you have any questions, please go to the website. There's a contact area, and send me your questions. I love to hear from subscribers, potential subscribers, and I'm happy to answer any questions that you have. Thank you.